Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and I got my buddy Tom Wall here back again, author of The Permission to Spend. We were just talking a little bit about Index Universal Life.
Yeah.
And
yes,
well, it was your words. What a fraud is this? No, listen, so I do a lot. If you watch this channel, it's no surprise. I do a lot of videos educating people about how Index Universal Life really works. Tom has done some really great presentations to his communities on Index Universal Life, how they actually work versus how they're sold and how they're represented.
Yep.
And so I guess I've got a couple things I want to cover, but before getting into that, I would love to just, if you could, give me just a couple bullet points as to the differences between whole life and IUL and why you are such a whole life advocate and so against IUL as a whole. Because I think a lot of people see them as very similar to each other. And a lot of people see IUL as like an enhanced version, or at least that that's how it's positioned.
Well, there's a lot of sizzle there. And, I will preface it by saying, in my experience, and I've had a lot of experience, I've spent 20 years traveling the country speaking with thousands of advisors from all different walks. And I think that 99.9999% of them are trying to do the right thing for their clients. Mm-hmm. I don't think most of this is missold as trying to defraud people or trying to mislead people. I think a lot of it's just lack of understanding because they're so complex. I mean, most insurance advisors don't understand how they work.
It's true.
I struggle sometimes, and this is what I do for a living, looking behind the curtain and seeing what's going on there. Mm-hmm. So I'll just preface it with that. When I look at whole life insurance, it's very clear. I talk a lot about whole life insurance as a great fixed income alternative in your portfolio, meaning an alternative for bonds and cash and things like that. And the reason for that is it's all guaranteed. They can never ask you for more money. They're guaranteeing you as long as you pay that money, you're going to have guaranteed cash value growth. Mm-hmm. That cash value will equal or exceed the death benefit by age 100. It will equal the death benefit. And then there's enhanced, and all that's guaranteed. And then on top of that, they're going to pay you a non-guaranteed dividend, which has been coming since Civil War times. It's really just a question at what rate. That's all good stuff. And I can sleep well at night and I can invest more aggressively elsewhere because of that. With IUL, they don't guarantee you anything. What they do is they'll guarantee you, we're going to credit you a minimum of 0%. So if the market goes down 30%, you get 0. And if the market goes up 40%, well, the catch is there's going to be a cap on that. Mm-hmm. So it's always sold. There's downside protection with upside potential. And then they say 0 is your hero. Mm-hmm. And my rebuttal is, well, yeah, but the cap is the trap. Mm-hmm. Because once you start underperforming, you are mathematically excluded from catching up. Mm-hmm. You are forced to then put more money into the contract to make up for those losses. So I guess we'll get into it, but my takeaway is all of the risk has been shifted to you as the policy owner in an IUL. So you may be able to participate a little bit better in some of those up years, but if you really dig behind the curtain, which is frankly too complicated for most people to even understand, your best case scenario with an IUL over long periods of time is about what you're going to get in whole life anyway. But all of the risk is on you. To what? Maybe eke out a slightly better gain?
Yeah, you might get, 30 basis points potential, but even that is like a total Hail Mary.
And most of the time, these policies aren't managed. These are the policies are typically sold. Like your advisor's not going to be there 50 years down the road managing what was sold. You probably will forget what you own, and the people then won't know what you bought. So to have a contract that is going to do what it's supposed to do, with or without human intervention, that's what I want.
One of the things I always tell people is like, if you're buying this product to solve a problem in the future, which most people are thinking about retirement income,
right,
and death benefit and living benefits and all the things that it's sold for, right?
Right.
It's mostly to do with retirement. That's like one element, but then it's always looking at when people go, oh, well, IUL is just cheaper than whole life, because they're looking at it, like they look at the first 20 years for the costs and expenses of IUL, which admittedly it's cheaper than whole life on the front end.
Yeah.
But it comes at a great expense later. And my comment to people is like, if you're going to buy a product to solve a problem, you have to evaluate how that product is going to perform at the time you need it to solve the problem, not the benefits it's going to give you, up front. Talk to me about that.
The least important part of a life insurance contract is the first several years. So oftentimes these are marketed with low costs up front, or they'll give you bonuses, or they'll show ways to illustrate high values early on. But just like you said, like it doesn't matter unless you cash the whole thing out and quit the plan. It doesn't matter. You know, what matters is how it's performing later on in life, what the long-term value is, and not average return over time, but what is it doing year to year so that you can use it strategically. And the struggle is, you get an IUL, and if you've got loans against it, or you know, it gets a zero while you have loans against it, it becomes a management nightmare. And it may work. I'm not saying I try to be careful with this stuff. Because like I really don't believe a lot of them will work, but I think if it's overfunded and well managed, yes, it can work. But I keep coming back to why bother if your best case scenario is the same as you're going to get in a product that is guaranteed to work.
So I'm going to push back a little bit, like, and I get why you're saying that, but I always say an IUL can work if it's used for the intended use of it. The problem with IUL, the death benefit. Yeah. The problem with IUL is that it's now sold as like a tax-free retirement income stream alternative. Yeah. And it's, by a lot of people, it's being sold as a primary source that you can depend on. And for people that are doing this for 20, 30 years, saving in these vehicles, thinking that that's going to be their safe haven, it is a ticking time bomb.
It is. I mean, just use common sense. If you're looking at an illustration where you're borrowing at 5 and illustrating that you can grow it at 6, don't you think all of the capital on the planet would be moving toward that strategy? Yeah. Like if that actually worked, you know, Wall Street would be investing very differently than they do. So it's a fun spreadsheet to run, which is what a life insurance illustration is. It's a spreadsheet.
We'll get into it in a second. We got one here to show.
But that's the issue.
One of the things I always say is like, so there's a guy, do you know who Brendan Burchard is? So Brendan is a guy, I went through his like high performance coaching programs and all that stuff once upon a time. And he always would say, common sense is very seldom common practice. Yep. And right. And the interesting thing is like, I back away from this and I go, all right, if we look at this from an airplane view and just use common sense and we get away from the illustrations and we just think commonsensically about the internal workings of an IUL, and like I'm looking to make a decision, IUL or whole life, and I say, all right, do I want to be a business partner on the whole life side, which is what you are, with the insurance company, or do I want to be a profit center for the insurance company? That's first and foremost. So in any situation, would you ever want to be a partner with somebody or a profit center for somebody? I think partner is always the way to go. Right?
I want to be sitting on the same side of the table, that's for sure. Yeah.
Exactly. So if they're successful, you're successful. That's first and foremost, right? Then the other thing is like with all these illustrations showing 6%, and they're being sold as, well, even some companies are more than 6%, but let's just say 6% for argument. Now, granted, in the last 6 months, 7 months, things have gotten a little better. You know, performance, the fixed markets have gotten better. But before that, they were still illustrating 6% and even higher when the fixed market was down in the 2 to 3% range, right? Like it was what it was. Right. And the general funds for these companies were doing 4 to 4.5%. So in what world, after the cost of insurance, after mortality costs and the admin charges and all that stuff, is an insurance company going to be able to get you 6 to 6.5% if they're struggling to eke out 4 to 4.5% for themselves? If not good at math, that's a 50% increase over what they're doing for themselves. And if you believe that they can do that for you predictably and safely, and think that if they can do it for you, they wouldn't do it for themselves some way, shape, or form, like I almost don't know how to help you. Like, you know what I mean? Like if you believe that story, I don't know what to do for you. Can you talk, like, what are your thoughts on that?
It makes total sense. You know, if you think about, this gets a little technical, but an IUL, the way they fund it is you're not actually participating in the market. There is actual no participation in the market. What they're doing is they're buying an option strategy. Right. So they're using a portion of your premium to buy a call option spread. So if you believe in efficient markets where, you know, capital chases return, which it does, and there are sophisticated people on Wall Street doing that every minute, it doesn't make sense that there would be an advantage to do that over long periods of time. Maybe in a year or two, sure.
Oh yeah, you can have years where it works out better for you, but
over long periods of time, you know, options are priced accordingly based on you know what the alternative risk-free rate of return is on your capital. So I know that's a lot of jargon, but
Yeah.
it doesn't mathematically make sense, or again, like commonsensically make sense
Yeah.
that over periods of time you could outperform.
One of the things, and I'm really technical, and I know this stuff like inside out better than most. And it was funny. I was meeting with Garrett Gunderson up at his cabin, and we were going through a lot of this stuff. And he's like, Chris, like, I know that IUL is not all it's cracked up to be, and like I know I could explain a bunch of reasons, but like I don't understand it as technically as you. So walk me through it. But before I did, he said, the main, and I never heard this before, and it made so much sense to me.
Yeah.
But he goes, to me, the reason I don't like IUL is because I understand exactly what you just explained, the option strategy on the back end. And he goes, for me, by putting my money into an IUL over a whole life contract, I would be taking the power away from the life insurance company from doing what they do best, which is managing risk, and putting my money into a win-lose situation. And he goes, I, values-wise, only put my money into win-win situations, where if I put my money in, if the insurance company win, I win.
Yeah.
Right? And when I put my money into an IUL, the insurance company can win and I can lose.
They wouldn't know.
If I win too much, the insurance company's going to lose. Right? Like, and so that just doesn't make sense.
Yeah.
You know what I mean? And so from that perspective, he's like, IUL is a win-lose scenario when whole life is a win-win scenario. And I was like, holy crap, that's amazing.
And I would challenge that a little bit, because I don't think the insurance company ever loses. You know,
fair enough.
If that policy gets funded for 20 years and they get all those mortality charges and expenses, and then it lapses before you actually die, how good of a business model is that?
Yeah, that's, I mean, it's pretty good. Not to mention, if it lapses before you're 75, you're probably going to get hit with a pretty big tax liability at the same time. So pretty bad. Here's what I want to do. I want to go through. I'm going to share my screen here, and we're going to look at an illustration, and I want to talk through this. Now, full transparency, everybody. We just talked about this a little bit going in before we started filming the video. But here's what we have. This is an Allianz Pro Plus Advantage illustration that was shared with me by one of the viewers once upon a time that they had gotten from another influencer. And you know, they talk about IUL, and one of the things that, and they're huge proponents, one of the bigger proponents for IUL across the country, and they swear this is the best product in the world.
Yeah.
The thing with IUL is that there's always 50 basis points of positive arbitrage. Okay? When you're looking at the illustration, 50 basis points of positive arbitrage. What does that mean? That means when we're looking at this right here, and I'm going to shrink this a little bit. When we're looking at it down here, you see we have loan charges and we have loan credits. So what that means is if you're charged 5% for a loan charge, you're going to earn 5.5%. Now, that's not how it really works in real life. You and I know that, Tom, right? Mm-hmm. But most people look at this and they go, oh, well, you know, why would the insurance company lie?
Yeah.
You know? So you can see here that, and this is kind of what you were alluding to before, is like if anybody could put their money in here and pull this off on a guaranteed basis every year, every dollar in the world of sophisticated capital would be going into these products.
Yeah.
And it wouldn't even be a competition.
With additional leverage, yes.
Exactly, right? Bingo. And so here's the deal. We look at this as it keeps going down, and one of the things people say you can't lose in an IUL because of the fact that you have the floor of 0.
Right.
And that's true. But there are always charges. There's always cost of insurance. There's always admin fees, and admin fees can fall off, you know, as it gets older. But we have this outstanding loan balance that when you start taking this income, it starts compounding, right? You look over here and you can see we've taken $189,000 of income, but we also have loan charges of $25,000. So now we have $215,000 of actual outstanding loan balance, even though we've only taken $189,000 of income.
Well, if I may, too, it's, you know, if you think about what your cash value in a life insurance plan is, it's equity. Mm-hmm. So putting it in a real estate format, so it's your equity. So if you have an outstanding loan balance of $215,000 on a house, this is a bad example of a house, but with this much equity in it, and the house value goes down, you're closer and closer to being insolvent. So think back to 2008 when people were foreclosing on mortgages. They had $400,000 loans against a $500,000 property.
Yeah.
That dropped down below 400, and all of a sudden they owe more than it's worth.
Totally.
In a life insurance plan, that policy goes away, right? You can't just live in it until the values come back up.
Right. No, 100%. Exactly. And so there's what's called an overloan protection rider on a lot of these, right?
Yep.
But a lot of people don't realize is that overloan protection rider doesn't kick in until you're 75, right? So if you overloan and if it lapses before you're 75, big taxable consequences.
Yep.
Right? Most people don't realize that, and it's sold as if they're there. But now let's go to the next page and let's talk about, like you can see here, that the loan balance by the time you're 70, still below the age where you have the protection from the overloan protection rider. Your loan charges total are $110,000, but you're actually ahead. It's saying you've earned $17,000 more in loan credits than you've paid. Now, what this is showing, this illustration is assuming you're paying interest. This is the interest, and you're earning 5.5% every year. Now, we all know that the market doesn't really work like this, right? You're not earning 5.5% and paying 5% every single year. The market could do 0 technically, and you're going to be on the hook. That 5% interest expense isn't going to get covered by this loan credit because there's going to be a 0 loan credit that year, or a 0 credit policy credit. Right. You're going to be stuck. This $22,000 is going to have to come out of right here, right? That's important to understand. But here's something else to understand. This $489,000 has a 5% expense that's associated with that. So what's that? It's almost $20,000, right? So now we have $22,478. You got plus another 20. Basically, got $40,000 of extra expenses that are going to be taken off of this 331. What's 40,000 out of 331? That's like a 13% loss, right? So people say you can't lose in an IUL because of a down year. You just lost 13%. And by the way, that's on a 0% year.
Yeah.
You know what I mean? Like the market could do 1 or 2% and you're still losing money. Anytime the market performs less than the cost of interest, you're going to lose money in this IUL and it's going to be amplified.
So to take that a step further, I see one of the biggest risks that I see with IUL is when you have 2 bad years in short order.
Big time.
Because think about it mathematically. If you were illustrated to get, say, 6%, okay? Simple interest in year 3, you should have had 18%, right?
Yep.
With compound interest, it's probably more like 20, 21%.
Okay.
So in a policy that has a cap of 10%, if you have 2 or 3 bad years in a row and you're behind, right? Let's just say there's 2 zeros. How many 6s, or how many times do you need to hit the cap?
Yeah.
Just to catch up?
It's impossible.
And the answer is 3 times, and then you're due for a market correction again.
But you can't. It's even more than that. You're right. As long as there's no outstanding loan balance, and then as soon as you start adding, if that happens, if you have 2 or 3 bad years in a row when you're in retirement, there's no catching up.
Correct.
No catch. There is 0 chance. You have 2 or 3 bad years in a row at this point in time, like we're showing.
Yeah.
You're fried.
Yep. Yeah, that was an example with no loans in existence.
Exactly. Yeah. So now you take the loans and you pop it on there and you start realizing what this looks like. And literally you're talking, 13.
Well, zero's not 0. Zero's -5.
Yeah. No, zero's worse than -5.
Before mortality expense.
Because that's before. I mean, it depends on what your outstanding loan balance is. The more mature the policy gets, the worse it gets, right? Yeah. And this is why I say to you, like, if you're going to buy an IUL, you can't think about what the IUL is going to do for you, when you're age 41, right? And you're going down through and like you're not utilizing it. And yeah, your cost of insurance is going to be lower than a whole life during that period of time. And okay, whoop-de-doo.
Right.
You know what I mean? Like, yeah, your cash value is going to build, but I could show you a whole life policy. Your cash value is going to be pretty comparable. What matters on this, if you're buying it for retirement income, is how is it going to actually perform when you're taking the retirement income? That's all that matters. Am I wrong?
That's why you're buying it.
That's why you're buying it. That and legacy, right? And so now the problem is 2 or 3 bad years. Can you imagine putting yourself in a situation, now you're 70 and you've been relying on this thing, and then there's 2 or 3 bad years in the market. Now all of a sudden, all your income potential goes out the window for the future, and your legacy goes up in smoke with it, and the living benefits that you were sold this with get destroyed all at the same time.
And I just love that I love that the income is just illustrated forever. Like this is just perpetually going to deliver this.
Yeah, I mean, It makes sense, right? Like, if you look at this, you look at the outstanding loan balance. By the time you get to 85, you got almost $2 million in loan balances. That means, think about this. Let's say you happen to, like, and this is never going to happen, by the way. I'm going to preface this really cleanly. But let's say you bought this policy and it happened to be that it was positive every single year from the day you bought it.
Yep.
And then finally, if this doesn't show you what a fraud this kind of policy is, I don't know what to tell you. But finally you hit 85 years old. And assuming you had positive years every year, you got $211,000 of cash value. Mm-hmm. You have $1,800,000 of loan balances. It's assuming you got this credit. You're taking the $37,000 of income. Check this out. One negative year with a 5% interest, that's almost $100,000. Mm-hmm. You got your loan charges, $87,000. Okay, so you're basically $180K in loan charges, plus now your cost of insurance. That's going to eat up your $211,000. One bad year, assuming even assuming every year before that was positive. One bad year at 85, and this thing goes up in smoke. Now imagine you're like my wife's grandfather right now is 86 years old, and I just think about him sitting at home having a policy like this and relying on it. What his life would look like right now if this blew up on him at that point in time, dude, he'd probably roll over dead, like not even joking.
Yep.
And have nothing to leave for it. Like it would be catastrophic. But this is the reality of how these things work. But the problem is people don't know how to look at these and evaluate them and understand these moving numbers because they're just say, hey, no, focus here.
Yeah.
That's it.
Yep.
You know? Anything I'm missing here? Anything you want to add?
No, it's just illustration porn. I mean, it's a
illustration porn.
It's just,
I love it.
It's a spread. You can make a spreadsheet and do anything you want. You know, reality is not a static world. Like there's no such thing as a static rate that happens anywhere.
Yeah.
So
especially. Yeah, no, I love it. So, all right, guys. Well, hopefully that makes sense. If you have any questions, comment in the comment section below. If you haven't already, make sure you follow Tom because Tom is on Instagram. He's not on YouTube. We're going to get him on YouTube. We're going to fix that. Like, yeah, we're definitely going to fix that. I feel like I need somebody like you on YouTube with me to like fight all the trolls out there. But anyway, you know, this is, and I'm telling you, this is the most popular product, the most commonly sold product for Index Universal Life in the country right now.
Yeah.
It's the #1 selling product. People are buying it for all the wrong reasons. This is why I have my book coming out, IUL Exposed, the truth about the most misrepresented financial product in history. This is why. Mm-hmm. And I watched a video today of people like this new IUL product coming out saying they're going to do one call closes on IULs. It's like, how could you in your right mind put somebody into a product like this with one call, not having all the information, just telling them like, hey, look at what you can do. This is where all your money should go. And like, and you said something earlier that before we finish, I do want to say, I agree with you that I think 99.99999% of the people are wanting to do what's right by their client, and they just don't know what they don't know. I remember I got into this business. I sold IUL for 4.5 years before I realized what was up. It's one of the reasons I have the passion to educate people about it the way that I do, because it's like, man, I wish somebody had done this for me sooner, you know what I mean? And the challenge is, I believe the biggest problem is the companies. Mm-hmm. We've had regulation AG 49 come out in 2015, 49A in 2020, and now 49B in 2023. Those are all regulation changes, guys, that impact how they're able to illustrate. And the problem is, it's like, I always use the analogy of like the feds, the FBI chasing Al Capone back in the day. You know, like when you're regulators and you're slow and you got to operate within the book and whatever, and then you know the crooks are able to go out and just like move really quick and be nimble or whatever. The problem is they update these regulations, and then before you know it, these companies are figuring out workarounds so they can have this illustration porn keep going, right?
That's what sells. I mean,
that's what sells.
They're selling an illustration. They're not selling reality. You know?
Yep. And that's the problem. And so it's really key to understand not just what's happening, but why it's showing like this, and see if it is in alignment with reality, and see if it makes common sense. And if it does, and you're comfortable with it, then it's fine. But I would say most people that I've ever talked to. I think I've talked to one person ever that looked at it and was like, oh no, that makes sense. I'll take the risk. Like literally one.
Yeah.
You know? And so it is what it is. But
yeah.
Anyway, guys, hopefully you found value in that. Go follow Tom. I'll put his links in the description below. Make sure you like the video, share the video, subscribe to the channel, hit the bell, do all the stuff. I'll see you on the next video. Have a blessed, inspirational day. We'll talk soon. See ya.